What is the difference between a mutual fund, index fund, and ETF? Let's first start with a mutual fund. Mutual funds are operated by money managers and they pool money from investors to invest in different securities like stocks, bonds, or money market instruments. The money manager is typically active and they work to increase the value of the entire fund. To buy a stake in a fund, you have to pay the net asset value, which is just the market value for one share of the fund. Each mutual fund typically has a different strategy. Some are based off of investing in the broad market and they might follow an index like the S&P 500, while other mutual funds might invest in international stocks, fixed income securities, socially responsible companies, or even in specific sectors like manufacturing or energy. Mutual funds are not traded like a stock, meaning they are not traded during the day. They are traded at the end of the day to prevent volatility. Common mutual fund companies are Vanguard, Fidelity, and Oppenheimer. Now let's move on to index funds. An index fund is a type of mutual fund and it matches an index. For example, an index fund that matches the S&P 500 means that the fund holds the 500 companies in the S&P. So why would you invest in a mutual fund that follows an index or a certain sector like the manufacturing sector? First, they make sense for someone who does not have the time to research individual stocks. They are low cost, and the portfolio within an index fund typically stays the same. Lastly, let's talk about ETFs. ETFs are similar to index funds, except you trade ETFs like a stock, and the price moves like a stock throughout the day. ETFs can also match an index like the S&P 500. So why would you invest in an ETF? If you like to actively buy and sell stock and want to capture intraday spikes or falls, you would like an ETF. They are low cost and the portfolio within an ETF typically stays the same. There are also some tax advantages for investors trading large volumes. You don't have to pay capital gains as you redeem ETFs because you can redeem them for the shares of stock that underlie the ETF.